Good morning. My name is Katie Cahotis, and I am with Armanino. I'm a marketing manager here with our tax team. Welcome to our webinar today on year-end tax planning for high net worth individuals. Before we get started, I just wanted to help frame the bigger picture around the reasoning why we offer so much great content. We're helping, people redefine our possible, and so we want to bring the best education to y'all, and we're excited to have y'all today and listen to our presenters. So I just wanted to give you guys a few housekeeping notes so that you can stay engaged with our presenters and have the best experience possible. You should see the bottom icons on your Zoom toolbar, ask a question and the chat. You can ask a question or use the chat to submit a question at any time. We would love to have questions throughout the presentation, so please type away. If you have any audio issues, you can access your audio settings and test your audio when you're in the meeting. And you can follow these directions here on the screen. Today's webinar does qualify for CPE. In order to qualify, you need to respond to all of the polling questions and stay for the entire duration of our webinar. If you have any difficulties answering the questions, please email your answers to elevate@armaninolp.com with your name, date, and name of the webinar and those responses. Our learning objectives today are to review the impacts of the recent legislation. We're going to explain the potential results of charitable gifts and estate tax decisions, and we're going to explore some new income tax planning ideas. Shameless plug from my team here at our private client advisors. We put together every year a year-end tax planning guide for individuals and families. We would love for you to scan that QR code and you can download a copy of that guide. We also have a fun infographic on that page where if you just want like the key fact, like the top things, you can go there. But we would love to have you be a part of our guide family here at Armanino. It's a wonderful guide. We put a lot of work into it. We'd love to have you read it. Okay, so today I'm going to turn it over to our presenters.
Good morning, everyone. My name is Leena Gupta. I'm a tax partner in Northern California, San Jose office. I work with high net worth individuals for tax planning and compliance, specifically in stock option area. I also work with closely held businesses and help clients with estate planning. Debbie?
I am Debbie Van Dieven. I am also a tax partner at Armanino. I am in our St. Louis office, and I am in the private client advisors practice. So most of my focus is on high net worth individuals and the issues that arise for them.
And I'm Jonathan March. I am a tax partner in the private client advisors practice as well, and I am based out of Dallas, Texas, and I also work with clients in Austin, Texas. I specialize in helping my successful individual and family clients plan and minimize their personal, trust, and entity tax liabilities. Thanks.
Great, thanks everyone. So for our agenda today, we're going to cover income tax, retirement, business-related tax issues. We're going to have charitable giving, wealth transfer, and Q&A. Yes, and I can flash the QR code. I saw a chat in right now. I'll put the QR code at the end of the presentation so that y'all can grab that, the guide that we put together. Okay, so our first polling question. Everyone ready? How do you feel prepared for year end? Okay, we have a lot of getting there. That's probably good. It is December 8th. We're almost there. Okay, just a few more seconds if you're checking your email. Beautiful. All right. And so we have a bit even of yes and no, and we have a lot of getting there. Good job, everyone. Okay, so now I'm going to throw it over to Leena.
Thank you, Katie. Next slide, please. The American Rescue Plan Act implemented several provisions for businesses and for individuals to help us all get through the COVID-19 pandemic. Example, we had PPP loans, we had idle loans, we had SBA, bridge loans, several stimulus payments, employee retention credits, we had child tax credit, and many more provisions across different sectors. Some of these provisions expired and others have been extended. In addition, we had the Inflation Reduction Act that was signed in law in August this year to address our current inflation in the market. So as you are reviewing your year-end planning, it is important to not only focus on your 2022, but project your income tax exposure in 2023 and see how these measures impact your tax liability. So throughout our presentation today, we will review some of the planning ideas, keeping these provisions in mind. Next slide, please. Timing is everything. So a deferral of income or acceleration of deductions. So historically, we would recommend deferring income to the future years and accelerating deduction in the current year. This may not be the case for everyone. So what you need to do is you need to review your current year income and deduction and project your future income and deduction and determine where you can get maximum benefit from your deduction and pay lower amount of taxes on your income. So if you project your income to be lower in the future, then you may want to defer your income. But if this income, additional income, will push you into a higher tax bracket, then you may not want to do that. So you need to determine basically where you can pay the lowest amount of taxes in your income. Same with deductions, you need to determine where you can get the maximum benefit from your deduction, keeping AGI limitations and other limitations in mind. For example, if you're considering charitable contribution or contributing to donor advised fund at year end, you may want to see if it is beneficial to donate in the current year or next year, or double your contribution in 1 year versus splitting into 2 years. Okay. Next slide, please. Stock options. Before you even start with planning with the stock option, you may want to gather information on your different grants and prepare a summary of all your grants, including types of option grants you have, the number of options granted, number of options vested, number of options that you have exercised, unexercised options you're holding, shares you have already sold, and shares you're currently holding. Once you have summary of all your grants, review review with your CPA and financial advisor, and then start the planning for the stock options. We have in our office, we have a template that we use to gather the information when we're working with a client. So if you're holding vested, unexercised ISOs and your regular tax is higher than AMT, you may have an opportunity to exercise ISOs without paying an additional $1 of taxes. So basically, when you exercise ISOs, the spread between the fair market value at exercise and exercise price is an income for AMT. So when your regular tax is higher than your AMT, you can exercise ISO to the optimum point and bring your AMT equal to the regular tax. And that's how you exercise an ISO without paying any additional $1 of taxes. This is something you don't want to miss for the year end. Let's say if you have exercised some ISOs in the beginning of the year and the price has gone down, you may want to consider disqualifying disposition of your ISOs. Now, disqualifying disposition is when you sell your shares within 1 year of exercise or 2 years of grant date. And you report basically ordinary income lower of the selling price or fair market value at exercise minus the exercise price. So when the price, the price has gone down, you pick up less of an ordinary income. So that's something you need to look into. Also, if you have an ability to early exercise an ISO, and if you're considering doing the early exercise and making an 83B election, you may want to have discussion with your CPA and financial advisor prior to early exercise, as the tax implication for regular and AMT for ISO is different than from NSOs. Okay. Also, if you are holding vested, unexercised NSOs, you may want to review exercising and selling some of the NSOs to increase your ordinary income So, to allow additional ISO exercise. And sometimes the option grant allows for net exercise. Now, net exercise is when company cancels some of your shares to pay for the withholding taxes and many times the exercise price. So if your plan allows for net exercise, you may want to look into that, and you may want to consider doing that. Also, if your plan allows for early exercise of NSOs, you may want to consider early exercise for the amount that you're willing to put at risk and make an 83B election. So you start the holding period for long-term capital gain. Okay. One more thing I wanted to mention is that if you have a multiple option grants, it is extremely important to identify which block you want to exercise and sell. Otherwise, the company will do a FIFO basis. Okay. The source of funds. So you plan for the source of funds, not only for the exercise, but also for the estimated taxes as well, because the statutory rates for supplemental wages is 22% up to 1 million and 37% above 1 million. So your withholding may not be sufficient. So you may want to plan for timing and also the amount of estimated taxes that you have to pay. Okay. Deadline for exercising the options. So pay attention to the deadline of exercising the options, because if you don't exercise prior to the deadline, the option becomes worthless. Okay. And pay special attention when you're terminating the employment. Be aware that if your company allows more than 90 days post termination to exercise an option, the character will change if it is an ISO, because you only have 90 days to exercise an ISOs, right? So if it is more than 90 days, then it's ISO is basically now NSOs. Okay. Also, if you're negotiating a contract, equity comp package, do get your CPA involved. We had a client where he was offered one ISO NSO split option grant with early exercise, and we helped our client negotiate two separate option grant. One was for NSOs with early exercise for the amount that he was willing to put at risk, and we had him do early exercise for those NSOs and make 83B election so he can start the holding period for long-term capital gain. And we requested a separate grant for ISOs without early exercise, so he can exercise maximum 100K limitation per year. Okay, so make sure you have this conversation with your CPA if you're in the process of negotiating the contract. 1202 qualified small business stocks and 1045 rollover. If certain requirements are met under section 1202 at corporate level as well as at the shareholder level, taxpayer may be able to exclude gain greater of 10 million or 10 times the shareholder stock basis. So if you're holding 1202 stocks, make sure you have proper documentation to support the qualifications are met at the corporate level. And also make sure you as a taxpayer meet the qualification as well. Okay, it's extremely important. And also review different blocks of shares that you're holding and determine which block of shares qualifies for gain exclusion. And let's say if you have a QSBS stocks, but you have not met the 5-year holding period requirement. That means if you sold the QSBS stock before 5-year holding period is met, you have an option to do 1045 rollover. That means you can reinvest into another QSBS within 60 days of sale and tack on the holding period. What that means is, like, for example, let's say if you have a QSBS stock and you held it only for 4 years and you sold it, right? You can reinvest into another QSBS, and as long as you hold it for another year, that qualifies for, that meets the 5-year holding period requirement, and you'll be able to exclude, you may be able to exclude the gain. Okay. There's one more thing I wanted to mention, that the gain exclusion is per taxpayer. So you can create additional taxpayer by gifting to non-grantor trust. So you can create maybe an irrevocable trust for your children and gift some of these stocks into the irrevocable trust, and you can have multiples of, $10 million or 10 times this basis gain exclusion. Also, I wanted to mention that you will need to get the separate valuation for gifting. Company may provide 409A valuation, but you may not be able to use the 409A valuation for gifting purposes. Okay, next slide, please. This slide basically, shows the different taxes you have at the federal level. Top marginal tax rate, 37%. This may go up to 39.6. We don't know. Long-term capital gain, 20%. In addition, you have 3.8% net investment income tax. You also have 0.9% Medicare payroll tax. So, and also this is just the federal level. You may have a state level taxes as well. So when you're doing the year-end planning, you need to keep all of these different taxes in mind. I'm going to hand it over now to Debbie for next session of our presentation. Thank you, everyone.
Thanks, Lena. I found that as we come up on year end, typically this is the time of year when most of my clients are reaching out to me and they're saying, what can I do to save taxes, now that year end is approaching? And the first thing that always comes to mind, of course, is retirement plan options that they might have. So there are many different kinds of retirement plans, most of which you're probably familiar with. There is probably the most common is the 401k. And in 2022, you can contribute $20,500. Can you move the slide forward, Katie? You can contribute $20,500 for that, and $27,000 if you're 50 years or older. And those amounts are increasing up pretty substantially for 2023. We don't usually see them go up in the $2,000 increments. So it's $22,500 and $29,000 if you're over 50 years of age in 2023. Now, if you're coming up at the end of the year and you realize you forgot to up this during the year, some of your employers will work with you and you can make a large contribution in your last few paychecks of the year to kind of catch up to the extent that you can. Now, another way to save for retirement is IRAs. Now, anyone with earned income can make a contribution to an IRA. The question is it a deductible IRA? And the income limitations for taking those deductions are relatively low. So if you're a single taxpayer and you're making $73,000 or a married filing joint and you're at $116,000, you can make the contribution, but it's not going to be deductible. There's also income limitations for Roth contributions. They're a little more generous. It's $144,000 for a single taxpayer and $214,000 for married filing joint. So if your income is over those limits, then you can't even make the Roth contribution at all. So I'm sure a lot of you maybe have heard of the concept of the backdoor Roth. And that's where you go ahead and make your non-deductible contribution to your traditional IRA because you have the earned income to support that. And then you immediately roll it over into a Roth. And since there's been no gain, that you can even roll it over the same day, you can roll it over and then it's non-taxable. But the big caveat here is, do you have other dollars in an IRA? Because if you do, then a portion of that amount that you're rolling over into your Roth can become taxable. If all your money is in a 401k, this is a strategy that works well for many people. But if you moved employers, pulled money out, put it in an IRA, then this might not be as beneficial for you. There's also the simplified employee pension plans, which most people refer to as a SEP. This is if you have self-employment income, and the deductions here are much larger. You can contribute around 25% with a few tweaks of your net earnings to a SEP in any 1 year. And you can give up to $61,000 in 22 and $66,000 in 23. So clearly that's a much larger bang for your buck here than you do with 401k. But even larger than that is what's called the defined benefit plan. The other three plans I discussed are defined contribution plans. That means the IRS says, this is how much you can contribute. With a defined benefit plan, they look and they say, what do you need in retirement? And if you say, I need $5,000 a month in retirement, then they go through their calculations to determine what you need to contribute now to have that type of benefit in retirement. So this only works well for a very small group of people. Typically, you want to be in that, maybe over 50 range, have self-employment earnings, and have maybe very few or no employees or younger employees. But if the circumstances are right for you, I've seen deductions over $100,000 in this area. Would you move the slide, Katie? Thank you. So another option that if you're working with financial advisors or your tax accountant, they might be saying, hey, do you want to consider rolling some of, converting some of your dollars from a traditional IRA to a Roth? Now, when you do that, there is a tax cost. So the converted funds are generally subject to federal income tax in the years that you make the conversion. So what you really want to what you're trying to figure out here now is, do I think the tax rate is going to be higher in retirement than it is now? And if that's the case, it probably makes sense to go ahead and convert now. Now, if you're in a very high tax bracket now, the top tax bracket, and you know that in retirement, you'd probably be in a much lower tax bracket, maybe it doesn't make sense. So this is a little bit of guessing what we think future tax rates will be and your income level stream in retirement. What a strategy that I found that seems to work well often is if you have some NOLs from a business that you're involved in, and you're going to have large losses on your current year tax return, that could be a great year to convert some of your traditional IRAs to Roth, because you could do it at a relatively low tax rate. Could you move the slide, Katie? Thanks. So another thing that comes up at the end of the year is required minimum distributions. Do I need to take one? And typically your wealth advisors are on top of this and letting you know what you need to do. But if you are turning 72, you do need to take an RMD by the end of the year from your IRA. You can also have the option of taking that and contributing it to a qualified as a qualified charitable contribution. That means you don't even take the tax. It goes right to a qualified charitable organization, and it's never even picked up in your income. I think Jonathan's going to touch on this a little bit more in detail when he talks later. And there's also been some changes for inherited IRAs in the laws over the last couple of years, and they've really not been favorable changes. Previously, when you you received an inherited IRA, you had the option to stretch that over a long period of time, depending on your age. But the law a couple of years ago, the Secure Act changed that. And now if you're a non-spouse and you get you're the beneficiary of an inherited IRA, you're required to put it in an inherited IRA. And in that case, you have to distribute all of the income, all the dollars in that IRA within 10 years following the death of the original owner. There are a few exceptions for designated beneficiaries that are minor children or disabled individuals. But for the most part, most people are going to have to stretch this over 10 years. Could you move the slide? And one more time, Katie, thanks. So I know this is a webinar on individual tax issues, but I know that many people are involved with pass-through entities, such as S corporations, partnerships, and those items are flowing through to their individual return, even though they're business-related issues. So one thing that people are always interested in, seems, is the mileage reimbursement rate, which has been increasing significantly over the last couple of years. In 2021, it was 56 cents a mile. For the first half of 22, it was 58.5 cents a mile. For the second half, they raised it to 62.5 cents per mile. They have not yet announced the 2023 rates, but the common thought is that they'll probably stay at that 62.5. They won't be going higher. Gas prices have kind of leveled off. Another item that came as part of the relief for the pandemic was that the 100% deduction for food and beverages. So for the years 2021 and 2022, if you had meal expenses, food and beverages it was purchased from a restaurant, you could take a 100% deduction for that. Typically that is at 50%. The entertainment portion, though, is still fully non-deductible, unless, there are a few exceptions, and such as a company-wide party, which I know a lot of people are doing here at the end of the year. That does remain 100% deductible. Would you switch a slide, please? So I know a really hot topic these days is the pass-through entity tax. A lot of states are starting to enact laws in this area. So as everyone knows, with the Tax Cuts and Jobs Act in 2018, the individual state and local tax deduction has now been limited to $10,000. So that means for a lot of people, their real and property taxes are at $10,000. So they're not even getting any deduction for the income taxes that they're paying. So states, particularly on the East and West Coast, with some of the higher tax rate, we're trying to come up with a way to work around this. So typically what happens if you have a pass-through entity, and I'm talking, partnership, S Corp, LLC, the entity pays no tax at their level, and all of the income from that entity is passed through to the partners or shareholders. Then those partners or shareholders, they file their federal tax return and they file state tax returns, and they pay tax at the at their state and local level. But again, that's limited to $10,000. So alternatively, what many of the states are doing is they're coming up with the pass-through entity tax workaround, whereby there's a deduction for your state and local taxes at the entity level. So the entity is actually paying the state and local taxes on behalf of the shareholders and partners. And at the entity level, taxes are not limited to $10,000. So they're getting the full deduction for their state and local taxes. The K-1s are still issued. The top line income is reduced for shareholders and partners. And then the partners still files their state tax return. They still pay their taxes at the state level, but now they're getting a credit from the entity for the tax that was paid at the entity level on their individual tax return. And if you move the slide, Katie, I'll just quickly go through an example. I think it kind of helps to walk through how does this work and what does it mean? So I'll start with the example on the left-hand side. And this is prior law when no one was making a pass-through entity tax election. So let's say you are a partner in a partnership and your K-1 is generating $1 million of income for you. You're in a federal tax bracket rate of 37% and your California tax is 9.3%. So you have $1 million of income. You're paying $370,000 in tax at the federal level. You are paying $93,000 in tax at the state level, and you're self-employed. This is a partnership. So you're also paying your self-employment tax, so Social Security and Medicare of $18,000 and $38,000, all based on your $1 million of income, and your total tax is $519,000. Now let's look in the alternative. You have the opportunity to make the pass-through entity tax election on the entity does on their California tax return. So now you still made the same $1 million of income, but that California tax over in the left-hand column of the $93,000, that's now being deducted at the entity level. So the income that's being passed through to you now is only $907,000. So you have this $907,000, and then you're have the federal tax on that, which effectively now is giving you your state and local tax deduction. You're still filing California tax return and paying tax. You still have your self-employment taxes, but your Medicare base is also lower and you're saving dollars there. So you can save tens of thousands of dollars by making this pass-through entity tax election. And the issue that we were running into a little bit in 2021, California and New York were a couple of the first states to get on board with the pass-through entity tax election. And so it was effective in 2021, but many or most of the other states didn't have similar laws. So if you were in your home state, which I am in Missouri, it was not advantageous for me to make the California pass-through entity election if I had income there, because my state wasn't allowing the tax credit for the taxes then that I was paying at the entity level in California. So I would end up paying double state tax on my income, and it was not beneficial. But now, as of today, I think we have over 30 states that have made pass-through entity tax elections. So this is becoming more common, and they're allowing for that credit in your state. So, but there are still a few caveats. One being, make sure that your state has a law in place. And also in some of these states, and it's an all or nothing election, like all the taxpayers have to make it, or none of the taxpayers. So in the example I just gave, if I'm a California taxpayer and 80% of my partners are in California and they wanted to make it at the entity level, that could really harm me. Now, California is not like that. One partner can make it, one doesn't have to, but just something to consider. And also you want to look at the tax rate. So most of the states are enacting a flat pass-through entity tax. I know that California's is at 9.3, but if I'm only at a 7% tax rate, I could end up paying more this way. Now, I know in the rules specifically in California, and every state's going to be different, is I can't get a refund of those overpaid dollars. I can, however, roll it forward to the next year. So it's just something to consider if you're making that election. Would you move it forward, Katie? So there are a few other pass-through entity issues that I thought I'd just touch on. These are things that can affect, if you're a partner in a partnership, an S Corp shareholder, or if you're a sole proprietor. basically if your income is being reported on Schedule C or E of your individual tax return. There is the net investment income tax, which Lena touched on, and that is, for most people, particularly if you don't have a pass-through entity, this is a tax that people are looking at, 3.8% tax on your investment earnings that are over $250,000 for a married filing joint taxpayer. And typically it applies to, interest, dividends, capital gains. But if you have pass-through entity income, it can also apply to that income too. Unless you are materially involved or actively participating in that pass-through entity, if you are doing that, if you are materially and actively involved, then that income gets excluded and you don't have to pay the net investment income tax on that. And I usually see that gets treated right on tax returns, but sometimes what I see missed is when you go to sell that business, a pass-through entity doesn't work if you're selling stock in a C corporation, but when you go to sell your interest in that entity, if you have been materially participating in that activity, that gain, capital gain, is also excluded from the net investment income tax. So let's say you sold your business for $20 million and that gets missed, that's a $760,000 tax bill. So you just want to make sure that that is being excluded from the net tax also. We still have the 199A deduction, which is the 20% deduction for qualified business income for non-corporate taxpayers. Again, this is a deduction for C Corps. It's just for those pass-through entities. However, that deduction does need to be on the K-1 that you are provided in order to be able to take the deduction. And the TCJA also brought us the gift of excess business losses limitations, which has now been extended through 2028. And this is now that in the past, if you had the base, let's say you have a startup company, year one, you're going to lose $750,000, let's say, that's part of your business plan. But you have basis, you could go ahead and take that full loss on your tax return to offset other income in that year. The excess business loss limitation now says you can only take that loss up to $540,000 if you're filing a joint return and $270,000 for individuals and trusts. So in that $750,000 example, you wouldn't be able to take the whole deduction in year one. But the only good news is that when it can be carried forward, and when it's carried forward, it actually changes character. It is no longer an excess business loss. Now it's considered an NOL. And it can only be carried forward. It can't go back. So it carries forward. And with a NOL, you don't have these income limitations or these loss limitations. Instead, your limitation is 80% of your current year AGI. So you can burn through those excess business loss deductions pretty quickly. And Katie, I think we have a polling question now.
We sure do. Have you read our 2022 year-end tax planning guide? Oh, I'm seeing a lot of not yets. That's a wonderful answer. Love it. Okay, again, if you're checking your email, here's the chance for poll question number 2. To get your CPE. Okay, I'm going to give you 3 more seconds. All right. So team, we have a lot of not yets. Okay, well, we'll definitely share that at the end, of course.
Okay, now I just want to cover a few more items that came out this year. Earlier in the year, the Inflation Reduction Act was passed, and it enhanced some of the credits that were already in place and extended them and changed their names a little bit for some of them. So a lot of these credits were due to expire at the end of 2022. And as you can see, many now are going on through 2032, 2034, and 2032. So that's good news. And they've been enhanced. So the energy efficient home improvement credit is a 30% credit when you put in like efficient doors, windows, water heaters, furnaces, things like that. And it's 30% of the cost of your improvement property with an annual limit of $1,200. And that is quite an increase over what it used to be, because previously there was a $500 limit, and that was a lifetime limit. The $1,200 you can do each year. The bigger credit is the residential clean energy tax credit. Now, these are for the big systems that you might put in your home. These are like the ones I typically see are the geothermal heat pumps and solar panels that people might put on their house. And you also get a 30% tax credit for these. And there is no limitation on that. So if you put in a $100,000 system, you can get a $30,000 tax credit, and there are not income limitations on that either. Although the credit, I think in 2022, it's 30%, it decreases slightly over the next 12-year period that it's in place. They've also made enhancements and limitations to the electric car credit. Now it's called the Clean Vehicle Car Credit, but you can take a credit now for previously owned vehicles, which was not the case in the past. Now you can take up to 30% of the price of the car or $4,000. Now the bad news is now they have imposed income limitations on the electric car credits. If your AGI is $150,000 for single taxpayers or $300,000 for married filing joint, you no longer get the credit. So I think that's going to hit taxpayers pretty hard because I feel like it was largely in those income ranges that I was seeing people take that tax credit. Just one other quick thing I wanted to touch on, Katie, if you move the slide, and that's just a few, if you're wondering, did these things change or where are we now? Personal exemptions are still eliminated. That happened with the 2018 tax law change. This is whereby, you get $3,000, let's say, deduction for each one of your children, no longer available but they have, however, enhanced the standard deduction to make up for that. So that's $12,950 in 2022 for single taxpayers and $25,900 if you're married filing joint. And if you're over 65, you get, a little bit more. The AGI threshold for deducting unreimbursed medical expenses is still at 7.5% in 2022. So that means you can only deduct medical expenses if they exceed 7.5%, to the extent that they exceed 7.5% of your AGI. So I do not see this as a deduction on most people's tax returns. There's only a few exceptions. If you had some kind of catastrophic or big illness or surgery, or if someone is in assisted living or a nursing home, and a lot of that can be considered medical expenses, then I will see a medical expense deduction. Individuals can only deduct mortgage interest on no more than $750,000 of qualifying debt, unless that debt was incurred before December 16th of 2017, in which case the limit is on debt of $1 million. And beginning in 2021, you can no longer carry back net operating losses on your individual tax return, with the exception of some farming losses, which can be carried back, but they can only be carried forward, but they are carried forward indefinitely and can be deducted up to 80% of your AGI in any 1 year. So really what I'm finding now in most people's tax returns is, for as far as itemized deductions, there's really only 3 categories we really see it. And now it's really your state and local tax deductions for the $10,000, your mortgage interest, and charitable contributions. So because miscellaneous itemized deductions have been eliminated. So that's all I got now. And I think it's time for, I don't know if it's a polling question or is it Jonathan?
We have a polling question before we get to Jonathan. What part of year-end planning are you most anxious about? Okay, I'm seeing a lot of income tax planning. Retirement planning is number 2. Okay, I'm going to give you 5 more seconds. All right, we're going to wrap it up. And so everyone knows it's income tax planning, then retirement planning, and then wealth transfer, and then charitable giving. All right, and with that, we're going to head over to Jonathan.
Thank you, Katie. So the next topic we will cover today is planning for year-end charitable giving. So charitable contributions remain one of the few itemized deductions that can make a large difference to reduce your taxable income. Charitable contributions and other itemized deductions, for that matter, offset income tax at the highest marginal tax rate first, which at the highest rate is 37%, or if you're an AMT, it's 28%. As with other itemized deductions, there are limits to the amount that you can deduct each year. For 2022, the limit for cash contributions to a public charity is up to 60% of your adjusted gross income, which is your income before deductions, or 30% of appreciated property. So think of stocks, land, artwork, a partnership interest. You may recall that the IRS increased the limit of cash charitable contributions to be 100% of your adjusted gross income for the 2020 and 2021 tax years as part of the CARES Act during the coronavirus pandemic. This 100% of adjusted gross income contribution limit expired at the end of 2021, and wasn't renewed by Congress for 2022. One way to reduce your adjusted gross income and still make a charitable impact for those who are required to take a required minimum distribution from their retirement account, you can consider making a qualified charitable distribution. This is a transfer directly out of your retirement account to a public charity. This partially or fully satisfies your required minimum distribution based on the amount required to be distributed and is a reduction of your taxable income. There's a limit for 2022 tax year of $100,000 that can be used as a qualified charitable distribution, as Debbie mentioned. Next slide. Okay, so some things to think about when you're making charitable contributions. So first is the holding period of non-cash assets. In order to get a fair market value deduction of an appreciated non-cash asset, the holding period of that asset needs to be at least 1 year and 1 day, so long term. If you were to contribute an appreciated asset with a holding period of 1 year or less, or short term, you are only able to deduct the cost basis of the contributed asset. Next is the timing of gifts. So all transfers must be completed by December 31st, 2022 in order to be considered a 2022 tax deduction. For checks, they must be mailed by December 31st. You may consider getting a certified receipt if you mail large contributions the last week of the year in order to substantiate any last-minute gifts that are mailed. If you are working with a donor-advised fund or other institution, the last business day of the year is Friday, December 30th. Some charitable institutions may not be open on Saturday the 31st to assist with making last-minute contributions, so please consider reaching out earlier in the month to complete these gifts. Complex gifts. So think of gifts of partnership interests, other closely held businesses, or other difficult to transfer assets. These transfers should be discussed with the receiving charity as early as possible in order to confirm charity will accept the asset contributed and ensure there is sufficient time to donate the asset. Some donor-advised funds require the contribution of more complex assets to be initiated as early as mid-November in order to ensure a deduction in the 2022 tax year. So take action on that as soon as possible. Qualified appraisals of donated property. For any non-cash, non-marketable security donation of property, you must have a qualified appraisal completed on the asset. This would include art, land, a partnership interest, any of those types of things and beyond. The appraiser must sign the second page of Form 8283, and that form, as well as the qualified appraisal, must be attached to your 2022 tax return when it's filed. Bunching of charitable gifts. If you and your spouse have a difficult time itemizing each year due to your deductions being slightly lower than the standard deduction, consider making 2 years of contributions in 1 year in order to double up or bunch your charitable contributions into 1 tax year and push you over the standard deduction threshold. Most charities are indifferent to whether they receive a contribution on December 31st or January 1st, so it's an opportunity for you to be tax conscious with your charitable contributions. Next slide. Okay, so one way to leave a charitable legacy is by using longer-term charitable vehicles in your planning. So the first one we're going to talk about is donor-advised funds. So this is a charitable vehicle that you create either with your investment institution. I know Fidelity and Schwab have these as a product, or with your local community foundation. Donor-advised funds allow you to fund a charitable contribution in 1 year, but disperse the funds to the charities over many years. This allows for a large charitable contribution in the year of a large income event to offset a large tax liability and still make positive impacts in the community for multiple years by distributing the funds over time. Donor-advised funds allow you to name the fund after your family, such as the Smith Family Charitable Fund. Most donor-advised funds will accept marketable securities or other complex assets, so contributions, but you should discuss this with the donor-advised fund before assuming that they can accept more complex assets as contributions. Many people consider donor-advised funds a great alternative to private foundations. Donor-advised funds do not have a large administrative burden, and there is no annual tax filing that comes with maintaining a donor-advised fund. Next is private foundations. So these allow a family to leave a charitable legacy, and it includes family members and the governance of the entity and making decisions for what happens with the distribution. Private foundations have a different annual adjusted gross income limitation for cash and appreciated property contributions, which is 30% AGI limitation for cash contributions and 20% AGI limitation for appreciated property contributions. So that's different than if you're donating to a public charity or to a donor advised fund. Private foundations file their own tax return, which is Form 990, and has many rules and administrative burdens that are required to ensure the foundation isn't being used to overcompensate family members. The third charitable vehicle is Charitable Remainder Trust. A charitable remainder trust is an entity that allows for the contribution of appreciated assets at the formation of the trust and generates an annuity payment back to the donor over the term of the trust. The remaining value of the assets at the end of the trust term are distributed to the charitable beneficiary of the trust. A charitable remainder trust must file a separate annual tax return, Form 5227. So that's some administrative burden for that. The last one is the Charitable Lead Trust. A charitable lead trust is an entity that allows for the contribution of appreciated assets at the formation of the trust and generates an annuity payment to the charity or charities determined by the donor. And the charity can be either, the charitable beneficiary can be a public charity, it can be a donor advised fund, or a private foundation. So there's more flexibility in the charitable entities that receive the funds. The remaining value of the assets at the end of the trust term are distributed to the residual beneficiaries, which can be either an individual or a trust. This type of entity, a charitable lead trust, also files Form 5227 as an annual tax return. Next slide.
All right, we have our last poll question. Awesome. Okay, would you like someone from Armanino to connect with you about year-end planning? And it's not too late. It's only December 8th, right? Okay, we have a few more answers needed. 5, 4, 3, 2, 1. Okay, just so we're transparent, here's our results with a few yeses, a lot of no's, and a lot of I don't knows. Okay, let's skip over to wealth transfer.
Okay, so wealth transfer planning. So the last section we'll cover today is year-end wealth transfer planning. So why you need to act now. So the lifetime exemption of each U.S. citizen through the end of 2022 is $12.06 million, or double that for married couples to $24.12 million. This allows you to gift assets to the next generations while you're alive, up to the lifetime exemption amount in place under the law. The IRS has already announced the 2023 lifetime exemption amount to be $12.92 million per U.S. citizen, which is an increase of about $860,000 per person. That's huge. The lifetime exemption is expected to go back down to an amount that is around $6 million, half of the current lifetime exemption, on January 1st, 2026, based on the date determined in the Tax Cuts and Jobs Act, unless Congress acts to pass legislation which would reduce this amount earlier than 2026, or it could also extend the lifetime exemption past 2026 at the current limitations. Making gifts while you are alive allows you to transfer assets to others and shift the future appreciation of these assets out of your estate. Next slide. Estate planning before the end of 2022. Here are some ideas to consider. Use it or lose it. In the current political environment, there are no guarantees for how long the large lifetime exemption will be around. As mentioned, the lifetime exemption is set to go back to pre-Tax Cuts and Jobs Act amounts on January 1st, 2026, unless there's legislation passed by Congress to extend at the current lifetime exemption limitations. Also, selling a low tax basis asset and gifting the cash from the proceeds. For this strategy, you would sell the appreciated asset, pay the income tax, and gift the cash to the donee. This accomplishes getting both an appreciated asset out of your estate through selling it and paying the income tax on the sale of the asset yourself. a further reduction of your estate without creating an additional gift. Next, decreased values of marketable securities in the current stock market allow for the transfer of assets at a low value and utilize a lower amount of your lifetime exemption. Next, grantor trusts are still allowed under the tax law. During the past 2 years of the Democratic-controlled Congress, there have been discussions of removing grantor trusts from the tax law or greatly limiting when they can be used. Grantor trusts are great methods of making a gift to a trust, while the donor still pays the tax on the income generated by the assets that have been shifted to the next generation. Your estate continues to be reduced by the taxes paid on the income generated without creating an additional gift to the trust. Another idea is to use one spouse's exemption and keep the other. So this is a scenario that may be beneficial if you don't have $24.12 million to give today, but you may in the future if the lifetime exemption is reduced back to pre-Tax Cuts and Jobs Act levels in 2026. The next thing to think about and remember is to update your estate plan, wills, and other accounts that have designated beneficiaries. Think about this. Have you had any life events that were not previously considered under your will, your estate plan, or your retirement accounts, such as a divorce or children being born? It is always recommended to review these documents and designations annually or when a life event occurs to make sure that they're up to date if something were to happen. Next is consider making distributions out of trusts to reduce the tax liability incurred at the trust level. Tax-paying trusts hit the highest tax bracket of 37% at $13,450. So distributing income out to individual beneficiaries who are taxed at potentially lower income tax rates could reduce the total tax paid on the income generated by the trust. Lastly, lifetime exemption increased by $360,000 at the beginning of 2022 to its current amount and is set to increase by an additional $860,000 on January 1st, 2023. So there are current and future opportunities to make large gifts if you previously fully utilized your lifetime exemption prior to 2022. Next slide. Okay, so here are some action items. While the decreased values in the stock market aren't ideal, they provide an opportunity for tax and estate planning. So consider harvesting losses in accounts to offset any capital gains generated within your accounts or outside of your investment portfolios. As a reminder, short-term losses can offset long-term gains. I know there are a lot of short-term losses generated this year in portfolios. Also, consider gifting marketable securities while values are low to utilize a lower lifetime exemption to transfer the same assets. Next, reach out to your tax advisor about any major changes that occurred during the year, marriage or divorce, births or deaths in the family, changes in employment or status with an employer. You might have been an employee last year and now you're a partner, so that changes your income tax filings. You might have started a business or you have significant expenses or deductions. If you have purchases or sales of properties, including your primary residence, these are examples of things to tell your tax advisor. Lastly, consider funding a 529 plan for younger generations' future education expenses. You can pre-fund up to 5 years of annual exclusion amount to a 529 plan per person, which is $80,000 for the 2022 calendar year. As a reminder, 529 plans can make distributions to cover up to $10,000 per year for K-12 tuition or all annual qualified higher education expenses for college education. So you do not have to wait until a student reaches college age to access the benefits of the 529 plan. That's it for me. Back to you, Katie.
Great, thank you so much. And I just wanted to pop in real quick. I'm going to extend our webinar to about 12:05. I'm in Houston, so Central Time. So whatever that means to you, about 4 more minutes. We have about 4 questions, so we'll try to go through maybe a minute at a time. Once you've contributed to a donor advised fund, are there requirements in how quickly you must distribute the funds from the donor advised fund?
Currently, there are no requirements. If you contribute it in 2022, you can distribute all of it out in 2022, or you can hold it in the account for many years. Under the current law, there are no required timelines for making distributions out of the account to public charities.
Great, thank you. Okay, we know how the 100% charitable contributions are treated when carried over to 2022. if they are not fully utilized in 2020 and 2021?
That's a good question. I believe that it's subject to the adjusted gross income limitation in the year that it carries forward to. Debbie or Lena, does that sound correct to y'all?
Yes. So if you're carrying forward, then you just look to the AGI in the year you carried it forward to, and you look to that AGI to see how much you can take as a charitable deduction. And you can only carry it forward for 5 years. So those can expire sometimes.
Great.
Great point.
Okay, is there a way to do Roth conversions but avoiding the increase in, I'm going to say this wrong, IRMAA premiums?
If basically, no. I mean, no. I mean, if you're making a conversion in a year and it's increasing your income, such, I think that they're talking about. I think that they're getting at if it's going to raise your, you know, the Medicare premiums that you have, and I think there is no exclusion, I'll say, for a Roth conversion. So if you've converted a Roth, you've increased your income, and that puts you in a higher rate of having to pay premiums for Medicare and prescription drugs. There's no workaround for that. So yeah, it can be an issue. Perfect.
Okay, we're gonna go. We had a follow-up question to our other question. So, does it come over as 100% or 60%? Is there a real question?
Oh, about that? There's 100%. So if you, like, let's say in year one, you contribute $60,000 and you could only take a $30,000, well, let's say you only contribute $40,000 or take a deduction for $40,000, such that you have $20,000 carrying forward, that full $20,000 carries forward. You don't lose any in the current year.
Great. Did HSA contribution limits increase for 23?
Yes, they have increased for 23. But I don't off the top of my head know what they are, but yes, they have increased.
Yeah, they have increased, like for self only, it's $200, and then for family, it's $450. So in 2022, it was $3,650 for self only. It is now $3,850. For family, it was $7,300 in 2022. Now it's $7,750 for the family.
Great, thank you. Okay, our last question. Do solar panels for pools get credit?
I don't know specifically, but I would think that there's a chance that they don't, because if these are home improvements, and I don't know that if you're putting a solar panel in for your pool, that it would qualify. But if you'd like a specific answer on that, we can get back to you. I've not had that question, and I'm not sure.
Yeah. Okay. Great. Well, thank you all so much. I did put in the chat, I put the link to our guide, so you have that there. If you have any additional questions that come up, you can reach experts at armaninollp.com, and we'll get back to you.